Hey, welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Is 2022 finally the year for active managers? They almost invariably underperform their benchmarks and index strategies over time. But 2022, seeing some active managers outperform. Among them are commodity trading advisors, CTAs, who specialize in trading futures contracts. There's an ETF for that. That's why we're here. Let's talk with the man who runs it. Andrew Beers, founder of Dynamic Beta Investments and co-portfolio managers of the Managed Futures Strategy ETF. The symbol is DBMF. Also joining us, my old pal, Andrew McGorman, managing director at Wallach Beth Capital. Andrew, this is quite remarkable. 30% this year up. I've heard people say this could be the ETF of the year.
Thank you.
Now, you're aiming to emulate the performance of 20 CTA hedge funds. Explain to us very briefly what CTAs do, what's in this, and why we outperform.
Sure. So I think simplistically, CTA hedge funds try to capitalize on big shifts in the market. And right now, we're in the middle of a huge regime shift. Right? We went from this low inflation world to one with high inflation. And the markets have spent 2 years adapting to it, trying to figure out what's going on. And so what CTA hedge funds have been doing, and they're having a historically good year, is as inflation comes back, they're finding different ways to make money on it. And so what we do in our ETF is basically try to understand what trades they're doing, and then to copy it in a low-cost, efficient way in an ETF to bring access to that to a broader base.
I want to clarify a couple things. First, even though they're called commodity trading advisors, they can invest in anything, right? They don't have to be just commodities. That's sort of an old-fashioned name. They can do anything, essentially.
I think the modern term is managed futures, and it's because they invest in futures contracts. In regulatory land, futures contracts are often treated as commodities, but we call them managed futures.
And you're not directly investing in any hedge funds. I want to make that very clear here.
Exactly.
You're using long and short futures contracts to try to emulate the returns, right?
Sure, that's right. So if they're betting on crude oil going up, no one goes out and buys barrels of crude oil and throws it into their garage. You buy a futures contract on it. When we see that the hedge funds are doing that, then we simply do the same thing. We ourselves buy a futures contract.
What is amazing to me was just looking at your positions right now. I mean, you're long crude oil, but you're short just about everything else. The euro, you're short gold, you're short the yen, you're short 2-year treasury notes. It's like shorts right across the board. It's really rather remarkable.
It is. We have been in crash protection mode, and that's been the right place to be.
Yeah. You know, Andrew, Andy, I'm going to call you Andrew, and I'm going to call you Andrew here. Everything's going right for these active managers, but only if you got the inflation trade right. So they're commodities up, rates up, dollar up. If you got that inflation trade right, then you're fine. But if you didn't, you're not fine.
Well, here's where I look at it. If, an alternative asset, a fund like this is diversification in a passive bull market, and you should have it. You don't expect that performance, you just have diversification. And then they shine in a market like this when they have their chance. It might be every 10 years, it might be every 2 years, but that's why you have it in place so you can outperform your beta and get some alpha when the market calls for it. That's what they're good at, that's why it's there.
Yeah, this is a really great example of the power of ETFs. One of the things I can't stand about this asset class, about hedge funds in general and CTAs, is they're very hard to access for people, and they're stupidly expensive.
Right.
They typically charge, 2 and 20 here, 2% of the fees and 20% of the profits. This guy's running this for 85 basis points.
Right, but also
0.85%.
Let's not forget that you have to be, if you're an individual, you got to be accredited to access one of these hedge funds.
Right.
You can't just say, hey, I'm going to put 20 grand into it. So accredited is a big thing, liquidity. And this is the big point, right? On this part of the show, we like to teach everybody what to do. Do not try to emulate this strategy on your own, with futures contracts using your E-Trade. You just really shouldn't. And that's what's so great about the power of ETFs. It's giving you access to an idea. Let the professional trade it. Right? The S&P 500 ETF, okay, it's only hard because you can't go buy 500 stocks. But otherwise, you could probably emulate an index with a few big names. This is not the case in this. It's an alternative asset where the pros need to do their job. He's offering it to you for 85 bips.
But, Andrew, I want you to clarify. This says it's actively managed. To what extent is it actively managed here? There's a model. You have a model, right? So you're looking at 20 CTA funds, right? Suppose you're aggregating, like the majority are long oil or short oil. You're aggregating this, and then you have a model, right? So to what is that active management?
Yeah. So each of those CTA hedge funds has their own models. And those models are trying to determine whether oil is going to keep going up, gold is going to keep going down, the dollar is going to keep getting stronger. Our models just figure out, based upon recent history, how they're positioned. Now, the reason it's called active is that even though the performance of it is very index-like, so when you say, what is an index of in the managed future space, there's no S&P 500 you can point to where it's easy to invest in. Rather, what you're saying is, what is a large collection of guys who pursue the strategy, how have they done on average? That's what an index means in this space.
Yeah.
And so we're actually somewhere between passive and active in that we are trying to give you index plus performance by virtue of the fact that you get diversification by virtue of the fact that we're looking at a lot of individual managers, and the plus comes from cutting out fees.
Yeah. So you have a model on top of a model, essentially.
Exactly.
Models on top of different kinds of models that are out there, right?
Exactly. Our model is the best way that we found to figure out today how these guys are positioned. We believe in the intelligence, the acumen, the sophistication of these guys. We just want to be able to copy what they do cheaply,
And
frankly.
these models don't all agree with each other. I mean, some might be long oil, some might be short oil, right? And you're aggregating that, essentially.
Right, and that's been the curse of investing in the space. Right, when you talk about
the wrong one,
access, they're all different, right? Yeah. So it's like saying, I want to invest in emerging markets, but you've got to pick between Brazil, which is having a good year, China's having a terrible year, India, et cetera. Yeah. But you need somebody to put all that together to you. And what we basically do is say, here's emerging markets, the equivalent.
You know, Andrew, I cannot figure out how the hedge fund business survives. I really don't. I've been at CNBC 30 years. I've watched this industry. And it amazes me. How do they keep convincing people that 2 and 20 is worth doing? How do you go to a pension fund guy and say, hire us? Or how do they keep selling themselves based on this? At least at 85 basis points, you see what's going on here. It's pretty
well. There's a portion of, let's just, what it is. Business is business, and there's people being paid to go and outperform beta or outperform the S&P 500 or outperform a Vanguard fund. That's part of it. But I also think any sophisticated investor is going to take maybe, let's say, 80% of his money and put it in this and take a shot at 20%, right? Or take a shot at 5% in an alternative hedge fund. If they hit that home run, if you get that 80%, that 100, that 150% return in a given year, you're not going to worry so much about the 20% going back.
Tell us practically how this really works, how this sale really works. And you were in the hedge fund business for years, right? So I'm a pick XYZ, teacher's fund annuity from wherever, pick a state, and I have advisors, right, to tell me where to do my asset allocation, right? And they're trying. Is it the advisors who tell you need to hire hedge funds to get some alpha here? How does that work? I mean, what?
Yeah. So look, like any part of the active management business, as Andy said, there's an industry around manager selection. And the industry around you ask, how do these survive? Is because, look at our space, right? There are guys who are up 100% this year and guys who are down 30% this year within the same space. So there are always guys who look like they can do no wrong. And I think the big lesson of the past 15 years has been the guy who did really well last year is just as likely to have a horrible year this year.
This is Vogels's central insight. There's no pattern.
Well, and the pension's not going to hire 10 of him in each different asset class.
But I want to get the point here is the people who make out well are the advisors who collect fees, of course, and the hedge fund. So you're an advisor to XYZ teachers annuity fund and wherever, and the advisor is telling them the pension fund is freaked out because they don't have enough to cover their potential liabilities in the future.
Right, and so the best allocators that I know in this space, right, have a formula for success, which is they recognize that they don't know who's going to do well next year, so they spread their bets. And if they're really big, like a sovereign wealth fund or a huge pension plan, they don't pay 2 and 20 like everybody else. They're going to go in and say, I've got $1 billion, but if you want it, we're not going to talk about a full fee structure. Those guys always outperform the average. And in a sense, what we've tried to do is emulate that model, but in an ETF with low fees, accessibility, et cetera.
So everybody can get it.
So everybody can get it.
You don't have to be an enterprise client.
Yeah. Well, what's fascinating to me is just that they can keep selling this year after year, this model, where everyone does well except the clients back and forth. I mean, long term, we don't see any evidence that hedge funds outperform.
Well, but the same thing has also happened. There's a world of hedge fund strategies that are in mutual funds, right, and have been in mutual funds for 15 years. The same thing happens there. You're an RIA. You're running your business, and you start getting calls from a salespeople. we've got a fund that's up 10% this year, and it's up 10% last year, and it's up 10%. You don't hear about the dozen other funds that haven't done well. The overall liquid alts world has done less than 2% per annum for the past decade.
Yeah, define liquid alts for people who aren't.
Sure. So these are hedge fund strategies so alternatives that are put into mutual funds and very rarely, but occasionally into ETFs, that are basically hedge fund strategies, but it's liquid because you can get in and out
of a day or.
Yeah.
Define what classes would you see?
So there's equity long short, there's managed futures, there are certain.
Your ETF is a good example. Yeah.
All right. So and again,
liquid alts are not like real estate, for example, timberland, for example, or it could be a REIT, but timberland is not a liquid alt.
Everybody has their own definition of it. There are publicly traded REITs out there. Some people call them alternatives. When I use that term, I'm talking about hedge fund strategies. So the stuff you would see in your proverbial institution, but somebody has taken one of those strategies and put it into a mutual fund to democratize it.
Yeah. To me, liquid means, I don't want to get too technical, but I don't want to use words that the viewers and listeners may not know. Liquid means easily bought and sold.
Correct.
I can get in one day and get out.
Timberland is not a liquid alt.
No, and a hedge fund will typically say you can get out next quarter, and things could like, hey, I need the money. I'm building a house. Like next quarter, that means not liquid.
Right. And the reason people have focused on it so much in the hedge fund world is that in the great financial crisis, you thought you could get out of hedge funds and you couldn't. Right, so you thought, oh, I can get my money out next month, and it turns out it took you 3 or 4 years to get your money back.
Yeah.
And so a lot
not because it wasn't liquid, because they couldn't sell at the prices
how about
they
private
wanted.
equity? Private equity, the company's not going to let you sell their shares. You might be in it for 6 years.
I don't want to call that liquid alt either.
Yeah, either. Yeah.
It's not. Yeah. So again, it's a terrible term because as you described it, it's vague. But what it describes is a mutual fund, right? And it's all about. And the point that I've made is when you have this area where you've taken these strategies run by really, really smart guys, and it hasn't done well for investors, it calls into question why you would want to democratize the space in the first place.
Yeah.
And so what we've been trying to do is actually, in the 15-year history of my partner Matthias's and my effort, have been to say, look, actually most ways aren't going to work. Right? Just recognize most things you can do as a hedge fund, you can't do in a mutual fund, you can't do in an ETF. Yeah. But what works and what works really well, and focus on that.
Yeah. Now I want to move on and show you another ETF that you run. This one's not a CTA, but it's a hedge fund ETF. It's hedge strategy ETF. The symbol is DBEH, and that models the performance of 40 long-short equity hedge funds. So this is long-short equity hedge funds. This is different than CTAs, and it uses futures contracts. Now, explain how this works. We put a screen up here that shows you a little bit.
Yeah. So our insight into, when you talk about this category, it's called equity long short. And the idea is really, really smart guys are going to know not just what stocks to buy, but what stocks to short, which means bet it's going to go down. Right? And so you're giving them basically two swords when they go into battle. Our conclusion was that most of what they get right are big shifts in the market. They get off the tracks as the train is coming down. Mm-hmm. They shift into, when interest rates start to go up, they shift from FANG stocks that are dependent upon low interest rates to more interesting value stocks, or vice versa. They go into emerging markets at the right time. And so what we do is we look at, again, a large pool of funds. We're not trying to tell you whether they own Meta versus Alibaba versus Cemex or anything else. Rather, what we're saying is, let's get those big factor shifts right. They're called factor shifts. And if we get that right and put it into an ETF, we've given an allocator a really valuable tool because it's less risky than equities, but can generate equity-like returns over time.
This is the same strategy as the first fund that we talked about, which is you're aggregating models, essentially, right? So, on aggregate, if this pool is long, these 40 hedge funds are long Apple 3%, you're going to try to emulate that, right?
Absolutely, except we don't do it with Apple.
Right.
We would do it with a futures contract on NASDAQ. Yeah. And again, our entire business, the only way we found to do this well, and by this I mean get the diversification benefits.
Well, 40's a lot. 40's a lot. That's why.
But,
I mean, that's good.
But how do you get the diversification benefits of those 40 hedge funds that you cannot otherwise access, but in an ETF with trading efficiency and all these other features, is to figure out their big trades and copy them.
You say you're using a NASDAQ future. You wouldn't be individual stock futures. You're talking about
overall NASDAQ, right? So if we see them in FANG stocks, for us, that's a NASDAQ futures contract. It's not a series of individual stocks.
Okay.
Yeah.
All right.
Big trades.
Yeah. So and explain what the cost is for this too.
Also
same
85 basis points.
Same cost structure overall as them as well.
Right, and so what we're trying to do is there are thousands of guys out there who run ETF model portfolios, which means stocks, bonds, and other stuff.
But they're not short.
Well, what we're trying to basically say is look, going forward in the 2020s, you have a different need, right?
Yeah.
60-40 and being long stocks and bonds entirely did incredibly well for a decade or more. It's a different world right now.
Correct.
And so we're trying to give you the building blocks where you can say, I want this much in this strategy, I want that much in that strategy, and it's as simple as investing in an S&P 500 ETF.
Yeah.
That's what we're trying to do.
Now, you also, I want to go back to the managed future, DBMF, we had talked about earlier. You pay a very large dividend on this, right? Wasn't it last year you paid like a 10% dividend?
Exactly.
And explain how that happened. And this was a taxable event, wasn't it?
Sure. So one thing to be very clear about the two ETFs that we run is that if you do an S&P 500 ETF, there's a big tax advantage relative to mutual funds in general. There is no big tax advantage in running an ETF with these kinds of strategies. So what happens is when we make $10, around the end of the year, there's going to be a dividend of the gains in it. Depends upon a lot of other criteria, but last year, the ETF was up, I think, 11% or so, 11.5%
the gain
year to date. So as an investor, you're going to see a lot of that coming back as a dividend. So just when you look at the performance of these strategies, you need to factor into it that the income that you receive over time is going to be taxable as it would in
comes back as a dividend. That's what I think a lot of people want.
Yeah, so in futures contracts, any mutual fund or ETF that trades futures contract recognizes all the gains on December 31.
Okay, so that's the answer.
That's the answer.
Short legal answer.
Flatten out the actual fund.
It's the future. It's the nature of the structure of the product.
It's what we invest in. It's futures contract.
You have to pay them out
exactly
at the end of the year. So that's the simple answer.
Yep.
I was trying to get to that to the viewers. It's not obvious. See, you understand that intuitively.
Like I'm getting yield.
But it's not.
But you are.
But
pay taxes
it's because you're trading futures contracts. That's the short
It's futures contracts. Yep.
And there was a drop in the fund at the end of December on that last year. And your point is you have to. It was distributed as a gain.
Sure. Right.
So you have to really look at the total return. Like if you just look at the price return.
Right.
It's not really truly indicative, right? Isn't it?
Absolutely. You've got to look at total return. And there are some databases out there that when you pull up the returns of it, it looks like every December it suddenly drops. That's not real, right? That's like saying I was in a bond and I got a big coupon out of the bond, but I don't treat the coupon.
Not even acting like it was there. Yeah,
it was there. So you have to configure. If you're going to look at it, you have to look at total return. You can see that in fact sheets. You can see that on the websites.
Okay. Well, you can see this is a fascinating subject. I love talking about hedge funds, but more importantly, ETFs provide an easy way to get into this kind of strategy. It's cheaper. It's more efficient. This is what ETFs are all about, whether you like or don't like hedge funds or CTAs. That does it for this week's ETF Edge. My thanks to both Andrews. We've asked Andrew McCorman to stick around and offer his perspective on broad ETF trends going into the end of 2022 for the ETF podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.